Hello, and welcome to another edition of Wealth Management Insights. I'm Ellen Zentner, Chief Economic Strategist and Global Head of Thematic and Macro Investing for Morgan Stanley Wealth Management. Today is Tuesday, July 28th, and I'm recording this from our offices in Midtown Manhattan. Artificial intelligence has quickly become one of the defining investment themes of this decade. So far, much of the market's attention has focused on the companies building the infrastructure that makes AI possible, from semiconductor manufacturers and cloud providers to the data center operators and the power networks supporting them. That focus has been well-deserved. Morgan Stanley Research expects roughly $800 billion in AI-related capital expenditures this year, rising to $1.1 trillion next year. The build-out remains substantial, and many of those companies could continue to benefit. But as AI adoption matures, investors may want to broaden the lens. The next phase of value creation may come from a different group of companies, those that can successfully integrate AI into the way they operate. In our latest Alpha Currents macro report, we call this the intangible CapEx cycle. Intangible CapEx is the spending companies need to make so AI can work safely and productively inside the business. It is not just buying a model or licensing a software tool. It is the less visible investment in usable data, cybersecurity, governance, workflow redesign, employee training, and measurement. And this matters because AI access is broad, but deep integration is still limited. Many companies are experimenting with AI, but far fewer have embedded it into production workflows of everyday decision-making. Basically, a company using AI to summarize documents is very different from a company redesigning a claims process, a customer service model, a logistics network, or a software development cycle around AI. History gives us a useful guide. The internet showed us that technology cycles often reward infrastructure first, but the more durable value can migrate to the firms that build new business models on top of the technology. Then cloud computing taught us another lesson. Infrastructure access alone does not create return on investment. Companies had to change their data systems, security, cost controls, operating roles, and governance before the full payoff appeared. AI appears to combine both of those lessons. It is broad like the internet, but operationally complex like cloud. That is why we think investors should watch not just who has AI exposure, but who has the capacity to absorb AI. One useful framework is an adoption matrix with two questions. The first, does AI create a real opportunity for the company? That means large volumes of repeatable cognitive work, proprietary data, recurring decisions, or expensive assets that can be optimized. And second, does the company have the capacity to execute? That means balance sheet flexibility, strong data governance, cybersecurity, management discipline, and a willingness to retrain employees and redesign processes. The best positioned groups tend to be firms with both high opportunity and high capacity. Think large financial institutions, scaled insurers and healthcare payers, large digital retailers, major logistics networks, and selected software companies. These firms often have large pools of structured work and proprietary data, and many already have compliance and risk management systems that can be adapted to AI. There are also high opportunity sectors where execution may be harder. Hospital systems, regional banks, mid-market logistics providers, and mid-sized retailers may have powerful AI use cases, but often face more fragmented data, tighter budgets, or more complex operating constraints. That does not mean they cannot benefit. It means the path may be slower and more uneven. The matrix also helps avoid a common mistake. Labor intensity alone does not equal AI opportunity. Construction is labor intensive, but much of the work is physical and unstructured. Freight brokerage, by contrast, may be more AI addressable because it involves matching demand and capacity across large volumes of structured data. We are already seeing early evidence of this uneven adoption. Morgan Stanley research analysts reviewed more than 10,000 earnings and conference transcripts and found that about 1/4 of S&P 500 companies were citing at least one quantifiable AI impact as of July 2026. That's up from 15% in the third quarter of 2025. Those impacts are still concentrated in technology, communication services, and financials, but the goal is to watch whether measurable benefits spread into more sectors over time. The labor story is also more nuanced than simple replacement. Morgan Stanley's AlphaWise surveys of advanced AI adopters found meaningful productivity gains, but also significant retraining and redeployment. In other words, successful adoption is not just about reducing headcount. It is changing how work gets done. For investors, the key point is selectivity. The AI infrastructure trade is not over, but the next stage may increasingly reward companies that can turn AI into faster decisions, lower costs, better customer experiences, and stronger margins. The first phase of AI rewarded access to scarce infrastructure. The next phase may reward organizational capacity. Thank you for listening. For more information, please reach out to your financial advisor to request a copy of Alpha Current's Intangible CapEx.